Hi, I'm Jim Cunningham, and we're going to cover the top 12 tax tips. They're for business owners and W-2 earners. I hope you enjoy it. Hi, I'm Jim Cunningham. I've got Chris Mann here. Today, we're going to talk about 12 hot tax tips for 2022 into 2023. We will also cover the Inflation Reduction Act. And Chris and I were talking before we got started. There's not a lot of there in terms of taxes in the Inflation Reduction Act. There's a little bit. But we've got an important mid-year election, a midterm election coming up here in November. We're in August of 2022. And, it's a very, very close. There's no majority in the Senate, right, with the vice president. So it's a 50-50 split. Very important election coming up. I'm Jim Cunningham. I'm the managing partner of Cunningham Legal, 25 years experience. As a lawyer, we have offices throughout California. We do help clients in other states. So if you're watching this in other states, we do have attorneys licensed in other states. I'm a certified specialist in estate planning, trust and probate law, real estate broker, and securities and insurance license, also a pilot. These are the attorneys in our firm. And this is Chris Mann. He's the M and Mann. CPA is 36 years experience, a certified public accountant, certified financial planner, and he's got tax industry specialties. He also happens to be my own personal CPA. So if I use him, there you go. That's I guess enough of an endorsement. So this is a disclaimer. Don't watch this and go out and do a bunch of stuff other than potentially firing some of your advisors you might have. But that being said, we're going to talk about a lot of stuff here, a bit rapid fire. And if you're watching this on YouTube, go ahead and if you have a question, put it in the comments section, subscribe to our YouTube channel. It's very important to stay current on stuff. And if you're watching this live, go ahead and put it in the Q&A. But, Congress passed this thing called the Inflation Reduction Act. And I said, there's not a lot of there. There is a little bit of there. We'll cover that. I think that there are consequences to elections and there are consequences to tax acts. And I will say, Chris, you and I have worked together for many, many years. Every year it's something different. It's like whack-a-mole, right? Every year something comes up that's a little bit different. You really do need to pay attention to this. So what are the parties proposing on taxes? We're going to go through the 12 tax tips and we're going to kind of add what the parties' views are on it. And really, we're in August of 2022. Now is the time to start planning for tax year 2022. Don't wait until February of 2023 to plan for 2022 because you might miss out on some important stuff. And so we're going to cover 12 moves that can really, really help you out. But let's start with the Inflation Reduction Act. Chris, you want to talk about this? I mean, what happened in here?
Yeah, I mean, most of it. Thanks for having me, Jim. I appreciate it. This act really did very little tax and not much in the way for anything for 22, really. It's for 23. It's good to start planning for some of the things. They've enhanced a lot of the employee or the electric vehicle credits, for buying, electric vehicles and things like that. There's a little bit of tax involved if you're a company and you buy back some of your own stock. There's stuff like that, but it's minor stuff. We thought there were going to be a lot more to it when they were putting some of this together, but they really have kept it to really just tax credits for electric vehicles, doing enhancements to your house that are energy efficient. There'll be some things like that would be beneficial. But again, these are things that are not going to take place till 2023. Also, I think the solar credit goes back up to 30%. Right now it's 26. So you have, a little bit of an increase there for 23 for that. But really, otherwise, there's not a lot of things that have to do with taxes. There's certainly no tax increases in this act, other than if you're buying back your own stock and you have a company and you're buying back some of your own stock, they're going to hit people with a 1% tax on that. But that's it.
Yeah, a friend of mine sent me this morning, which is basically the people who qualify for the tax credit are people who probably aren't going to buy an electric vehicle. So go figure.
Yeah, I noticed the income limitations are kind of low, and also the amount of the vehicle that you can buy is low too. I mean, it's going to be interesting. Not a lot of the vehicles that a lot of people probably want to buy are going to qualify for this $7,500 credit. And if you get tripped up on that, you're going to get maybe tripped up on the fact that your income's too high to take it.
Yeah, it might have been like a poke in the eye to Tesla. I don't know. So we have the elections coming up. Something very important to understand. We have 20 Republicans coming up for re-election and 14 Democrats. It's 34, a little bit more than a third of the Senate. 8 are contested. That's kind of weird because that means 26 aren't, right? I don't think there's a snowball's chance in Hades of a Republican being elected in California as a U.S. senator. So what we mean by this are there are some elections that are in play, but if anyone gets 5 out of 8, well, if the Republicans get 5 out of 8, if there's a change in one, control changes. So if it's 51 Republican and 49 Democrat, all those seats, right? All those committee seats go to Republicans, and if it's 51 Democrat to 49 Republican, the Democrats effectively stay in control. So something really important to watch. I mean, we're not political prognosticators, but on a very high level, I think if the Democrats are elected, you can look at higher taxes. If Republicans are elected, you can see lower taxes. However, when it comes to state and local taxes, do you want to talk about this SALT workaround? This SALT stands for state and local tax workaround. You know, this is not getting a SALT substitute, but if you can walk us through this, Chris, explain what's going on here.
Yeah, let me go back to what you were talking about with the election in November 8th. If the House goes to the Republicans, which most people think it's going to, then we're probably going to be at a standstill for the next 2 years, even if the Senate doesn't switch. It'll just be status quo, which isn't a bad thing. The tax laws I think are pretty good right now, especially for business owners, really good for business owners. So I don't think that there's going to be much change there because they won't be able to get, the Republicans won't be able to get anything done either. So it'll just be a standstill for the next 2 years if the House goes to the Republicans at least. Going to the SALT cap, that's a deal where in 2018, President Trump put in a deal where you can only write off $10,000 of your state and local income tax as state and local income tax and your property taxes on your house as an itemized deduction on your federal tax return. So the state of California came back and said, wow, people are getting hammered on this. They can't write off their state taxes. They pay a lot of state taxes. So we're going to come up with this called AB 150, where we can have your company, meaning an S Corp or an LLC, pay the tax that you owe personally, and then you get to write it off as a federal write-off. So you're saving up to 37% perhaps if you're in the top bracket for federal taxes. So people have started doing this in 2021. The law was a little bit kind of fuzzy on how things are going to work then. So when you ran the numbers, it only made sense for people well over 7 figures to do this. Governor Newsom passed a deal in February that made things better, that more people could participate in this in a good way. So now in 2022, more people are doing this. But in order to get into this program, you would have had to have given the state $1,000 out of your corporate or LLC tax return, or from your company to participate in the program for 2022. So if you didn't do that and you're not in from 2021, you can't do this for 2022. But it doesn't mean you can't do it for 23. What you got to do for 23 is give them at least $1,000 next June, and then you're in. But it's something you should talk to your tax advisor on because it's such a complicated thing, but it's a very beneficial thing. So I've got some guys that are paying 150, 200,000 into this program. And if you run the numbers and you think about 200,000, if you're saving 37% on the federal side, that's 74,000 you're saving in federal income tax. So it's a pretty big and powerful deal. And it's going to be with us at least till 2025, unless IRS gets rid of the SALT cap, which right now they haven't proposed to do. So we're probably living with this at least through 2025. So if you haven't gone over this with your tax professional, I would do that now.
Yeah. And so I ask clients, and by the way, if you don't own a business and you're watching this and you're like, well, this is great. We have stuff for W-2 people in here too. Don't worry. But when Chris and I were getting ready for this, you know, we both kind of realized the tax code really favors business owners on a very high level. And if you're not a business owner, maybe you're married and maybe one spouse works, the other one doesn't. Or maybe you are a W-2 earner. Think about doing a business. I don't know, come up with something and do a business, because there are a lot of things that you can do to save taxes if you're a business owner that you cannot do if you're W-2. So first of all, this does not work for W-2 people with W-2 income. It just doesn't work. Now, an entity, if you are a sole proprietor, this does not work, right? Correct, Chris? If you're a sole proprietor.
Right.
So
you got to be an LLC or an S corporation.
and so people say, well, I don't want to do an LLC. I don't want to do a corporation. I want to do a partnership. I just have to pay a lawyer a bunch of stuff and, accountants, blah, blah, blah. You'll see in a few other slides why it might make sense to do an entity for several reasons. And one of them is the SALT workaround. And I will tell you, how do you know if you're doing this or not? Well, Chris and I, we do tax planning, and we just had our meeting for this year. We did tax planning last year, and Chris said, hey, Jim, you need to write a big check in December to the state. And I'm like, are you kidding me? Why do I have to write a check to the state in December? Well, because Chris was on top of this, right? And I knew, so that helped me take a federal deduction off state taxes paid last year. So thank you, Chris, for that. I really appreciate it. If your accountant, your CPA has not asked you to write kind of a big check in state income tax, two things. One, you may not benefit from it. But two, if you're a business owner and you're making $1 million a year, you're making 500,000 a year or whatever it is, it really might make sense to do this. And if they haven't nudged you, if your CPA has not nudged you to do this, that is a sign that, that person's not, frankly, in my view, not doing their job. So let's talk about the employee retention tax credit. So what the heck is this? So walk us through this, Chris, maybe put some color on this.
Yeah, this was a COVID deal. Congress put this in place for 2020 and 2021. They're two separate credits. The 2021 is $5,000 per employee. So this, again, is for a business owner to take advantage of. It's to reward them for keeping their employees through COVID. And the way you qualify for them is different in each year. 2020's qualifications much different than 2021. 2020's is you have to have one quarter in 2020 where your top line income, gross income, not net, gross, is more than 50% down from your 2019 same quarter. So if you look at your second quarter of 2020, April to June, compared to April of June of 19, and you're down more than 50%, then you qualify for this credit for the whole year. So you go back and look at who you paid, how much you paid them, plus health insurance. And then you make sure you didn't use these same wages and health insurance to get your forgiveness if you did a PPP loan. You can't use it for both. But if you didn't, you can, but not everyone was able to use all their wages for PPP. So most people are qualifying for both PPP and this ERTC stuff. When they first put this in place, if you did the PPP, you couldn't qualify for this ERTC. They changed it midstream and allowed everybody to qualify for both. The 2021 credit's more lucrative. Instead of it being $5,000 for the whole year per employee, it's $7,000 per quarter for the first 3 quarters of 21. So you can get up to $21,000 per employee for 21. And you get these by amending your payroll tax returns. And they don't have the 4th quarter because Congress stole that money for other things to do other bills. And so they got rid of the 4th quarter in 2021. But still, the first 3 quarters pretty lucrative. A lot of people, if they don't qualify for the income drop, and the 2021 drop, your gross has to be down from 19 same quarter more than just 20%, not 50. So it's a much easier credit to get in 21. Now, more people were open in 21, so some people it's going to be harder to get the credit because maybe your income was back to normal. But if it was down more than 20%, you should look into this. The other way to qualify if your income isn't down by those numbers, either 50% in 2020 or 20% in 2021, is that you were partially or fully shut down by government mandates. And that's where you have to talk to your tax preparer, tax advisor about that whole thing, what qualifies, because some situations do, others don't. Like dentists were open during this time, but they were only open for emergencies at times. So that's a shutdown. They were partially shut down in their business. So they qualify, even if their gross income didn't hit the numbers, didn't qualify. They qualified because they were shut down by a government mandate or partially shut down. So that's where you talk to your tax advisor. And that if you own a business and you've got quite a few employees and no one's talked to you about that already, they already should have been, because there's still time to amend these payroll tax returns. You've got 3 years to still amend them. So the 2020 payroll tax returns can still be amended next year. I still got to, probably another 6-7 months to
Yeah.
get the.
And Chris, this is not like a beat up on your advisor. And I will tell you, in defense of CPAs, when the government, the act of pushing a bunch of money into the economy, which is basically what happened during COVID, they just stuffed a bunch of money in the economy.
Yeah.
The government was relying on the accountancy profession to deal with all this stuff. You guys have been working your tails off for the last 2.5 years. I mean, I just think about all the stuff you've had to go through. The PPP was on your shoulders, the ERTC. So it's not that your accountant is a bad person if your accountant hasn't been talking to you about this. They might just be totally overloaded. But on the other hand, it doesn't matter, because if you're leaving money on the table, you need to at least know you're leaving money on the table. You can choose to take this or not. But I think, most rational people would take it. So a lot of numbers, a lot of confusion. ERTC, employee retention tax credit. If you're a business owner and have employees and your advisor has not talked to you about this, nudge your advisor. And if the advisor may say, I'm just too busy, I can't do it, which I've heard that quite a bit, because people are overloaded, quite frankly.
Or they could say that they are going to get to it, but they haven't got to it yet, which is fine too, because like you said, you're 100% right. It's been the last couple of years added on all this stuff under our normal stuff has been challenging. And, obviously we're no different than anyone else, our industry anyway, in that staffing has been a problem, no different than a restaurant or other type of business.
All right. So consider creating an entity to operate your business. So a lot of people that I meet with have entities. A lot of people don't. And if you don't have an entity, don't beat yourself up, but please pay attention to this. When you run a business, if you do not have a corporation or a partnership or an LLC, you report everything on your Schedule C on your 1040. Okay, so we have Owen. He runs a professional service business. His profit from the business is $1 million. If Owen reports this all on his Schedule C, his tax bill is $522,000. But if Owen creates a corporation or an LLC taxed as an S corporation, his taxes are $92,000 less. No one's scamming the government. No one's cheating the government. It literally is structuring it in a different way. And Owen pays $92,000 less in tax. Again, this is shuffling the deck. And you, Chris, you referred me a client who didn't have this and was making these numbers. And we're going to be able to save the client $92,000 a year. It's fantastic. I mean, it's a no-brainer.
It's very similar. It's very similar. So it was new to us too. And we looked at the stuff and I said, you take your LLC and elect to be taxed as an S corp, we can create this situation that you have here. And it's all it is really just saving some on the Medicare taxes, really at the end of the day, what you're doing. And it's perfectly legal to do as long as you do a reasonable salary. Everybody goes, what's a reasonable salary? And depends what your industry is, depends what you're doing, facts and circumstances, how much you're working in the company, all those things come into play. But there is some potential for savings. And plus, with that AB 150 that we just talked about, it makes it a no-brainer in California to be an LLC, or at least an LLC, but really beneficially an LLC taxes an S corporation is usually your best bet as the way to run a small or medium-sized business these days.
So action item, if you own a business and you're reporting it on a Schedule C, reach out to your A team and decide, and at least have a conversation. Does it make sense to stay with the Schedule C, which is on your 1040, or does it make sense to have an entity? Speaking of A team, here's the A team and here's us. There you go. I thought it'd be funny. All right. What about, okay, when I saw this, my blood pressure went up a little bit that the IRS is going to hire 80,000 new agents. Chris, what's your take on this?
Well, first of all, they need more people. They definitely do. I feel bad. We deal with those guys regularly. They're great. I mean, they're really good to deal with, and they do, they work hard, and they do everything, to make our lives easier. We try to do everything to make their lives easier, but they are definitely needing some help. I mean, there's no doubt they need some help. I don't know if they need 87,000 or what 80,000 or whatever, but they do definitely need some help. I don't know how long it's going to take them to get those people, because I know it's tough to get. I've joked around with Jim before saying it's hard to even get to, and it's a tough environment out there for hiring, especially skilled people. And that's what they're going to be looking for, skilled people. So it's going to take them a while to get to that point. We'll see if they actually get to 87,000 or 80,000. but I wouldn't worry about it too much, because especially if you're doing the right things, nothing to really be worried about. And with the whole thing.
I mean, I'm putting in quotes what you said, Internal Revenue Code section 61. You did something, you got something, therefore it's income. You know, even if you don't get a 1099, and people get tripped up on the 1099s because they don't, you know, if you get this many 1099s and you report this many, it's real easy to audit you on that. But you know, the IRS is facing the same demographic pressures that everyone's facing, which is the baby boomers are retiring, the people with the institutional knowledge are retiring, and there's a whole new set of people coming in. So and you can see here, a big chunk of the current IRS workforce is going to be retired here in the next few years. So this is, I view this, Chris, frankly, is just replacing people who are retiring. And I saw another article this morning that said, how long is it going to take to train these people? It's not like you're going to push a button, get 80,000 people, and they're going to hit the street tomorrow. So
right, that's why it's not that. I've had some people ask me about it, concerned, and I said, don't lose sleep over that.
Yeah, and you know, hot tax tip number 5. Guess what? There's a low audit risk just in general. Just if you look historically, we're in a period where there is a low audit risk. That being said, if you operate as a sole proprietor, if you report that on your Schedule C, you are far. I think the figure is you're 20 times more likely to be audited. We do have a question from Richard. He says, "Can an Inc. take advantage of tip number 3, which is the example of using a corporation to take a salary?" Yes, it depends off if it's an S or a C, but an Inc. Corporations are either subchapter S or subchapter C. Apple is a subchapter C, big megacorp. Subchapter S would be a small business. Okay. Tell me what a correspondence audit is.
It's where they just send out letters to people asking them to verify, like maybe one thing, like I want to check out donations. You know, you'll get like a thing saying, I want the backup for this donation you took on your tax return, send it to us. Or it could be gambling losses, send me the backup for the losses, something like that, where you don't really meet with the auditor at all. You just get a letter from them, and then you say, and it asks for information, and then basically you just put it together, send it back to them, and then they make a determination whether that's acceptable documentation or not. And that's pretty much it. And I think we'll see more of those because they are more automated, and so they don't have to have so many people handling those things.
All right, so Chris, we talked about this when we were getting ready for this. You know how you'll hire someone and they say, well, it's cash only. And look, we all know what's going on, right? Someone who takes cash only, they're not reporting all their income. What does the federal government do versus what does the state government do? What does the state of California do on that, where someone's taking a lot of cash and they're in a particular industry? What do they do?
Well, there's nothing wrong with taking cash. The problem is if you don't report it, you can get paid in cash all day long. But the problem is, if you're not going to report your income, both the state and the feds are going to become very angry.
Yeah,
I mean, that's what they do. They don't get angry at, you know, if you want to discuss a deduction, you know, let's say I think we should be taking this much in auto or this much in meals or something, and then they go, well, we don't think your documentation backs up that, but we'll give you this. They don't get like angry about that as long as it's, you know, reasonable. When you start hiding income or not reporting it, that's when they get angry. And I don't blame them. That's where they get angry, and that's where you get in trouble. And that's the one that you can't really, there's no argument out of that. Either you're reporting your income, I don't care if you got it in cash or check or whatever, or you're not. And if you're not going to, then you're probably always going to be, you know, having a hard time sleeping. Because
doesn't the franchise tax board impute income if you're not filing a return?
They can, yeah, they do that to try to get you to file a return.
Yeah.
You know, the state will do that. They'll send you a bill because they're like, well, we've tried to get a hold of you. We've tried to get you to file a return. You've not done anything. So we're just thinking you made this much based on the information we have from third parties.
Yeah, that's one reason there's so many licenses in California. That's what, you know, you go to others, maybe a state that doesn't have state income tax. The one reason California has so many licenses is so you register and then they match you with your return. And if you're not filing a return, you know, they're going to take a wild guess and send you a bill. All right, Roth conversion. So I know we talk a lot about Roth conversions. If you have a traditional IRA, which means you have not yet paid tax on this IRA, the first half of 2022 was terrible. I don't know if, you know, I opened up my quarterly statement for the end of June, which I think was the bottom of the market. And my wife, she goes, "Oh my gosh, have you seen our statement?" I'm like, "I don't want to look." Right. I think a lot of people watching this had the same feeling, but it's come up a bit, right? But a Roth conversion is where you take money out of your IRA and you pay taxes now. Okay. But in the future, when you take that money out of your Roth, you don't pay taxes and you don't have a minimum distribution. So Owen has a traditional IRA with 100,000. So this is what's going on in pre-tax funds, 32% federal tax bracket. So when he does a Roth conversion, he's got a $32,000 bill. But if his account drops to 70, right, because the market's gone down, then he's paying less than he's saving 9,600. And you can add zeros to this if you want or whatever. But the point here is when the market's down, that's a really, that's another reason to look at a Roth conversion. I'm not saying do it or don't do it, but I will tell you a lot of our clients, when maybe a client retires at 60 and they say, you know, I'd really love to travel for 3 years. You know what? Go to France, go to Florida. Don't be a California resident. When you do your Roth conversion, you're not paying state income tax. So that's part of this, the A-team slide I showed, which is getting your A-team together. And Chris, I know you and I have mutual clients that they retire at 60. They don't start their minimum distributions till 72. A lot of people do a Roth conversion in their 60s because they don't have income, right? And it makes sense to do it. It's all about tax bracket arbitrage. Talk about that. This is, I chalk this up to basic tax hygiene, but walk me through this. Help me unpack this. Talk about, and this is a state income tax issue. Talk about the importance of paying your taxes on time, Chris.
Well, we're going into our tax planning season right now as we get to the end of the summer and into the fall. This is the time to do it. Between now and, let's say the middle part of November is the optimal time to do tax planning with your professional team, because that's when things can be done. You got time to do it. We do some in December. We might do a little mop up in December to look at, again, somebody we looked at in September to just verify that what we projected is coming to fruition. But you want to try to get this done by, let's say, the middle of November, just in case you got stuff you want to do, you got time to do it before the end of the year, whether it's buying something, setting up a 401k, the oil and gas, those things sometimes take time to do. So therefore, you want to have some time to figure out whether you should do it. The one other thing that's going to come up this year with this AB 150, which we talked about earlier, is those payments for people that are in the program for 2022 are going to be due December 15th. So it's imperative that we nail down those numbers early so people can plan to have that available to send to the state through the company. So it's a cash flow issue too. And so that's what tax planning is. And it's also a cash flow issue.
And if you wait until January or February or March, it's too late because you had to write that check before December 15th, right?
Yeah, you got to do it. Yeah, you got to at least pay in a big percentage of what you think you're going to owe by December 15th under this AB 150 program. And if you're not in that program, you still got to figure out where you are so that you're paying your estimates on time. And then let's say you owe more than your estimates because you're having a big year. At least doing tax planning now what you owe in April, so that somebody's not doing your taxes March 31st and saying, hey, you owe X amount of dollars. You're like, well, I didn't realize that was coming. It's like you knew it was coming. It's like we had a lot of people last year with a lot of money, because of various things, because they got all the grants and the monies from the COVID stuff. They all knew what they owed and they all were ready for it. It wasn't like we had one person come to me and say, well, Chris, I don't really have that money available because I didn't know it was going to be owed. They knew it was going to be owed and they were ready for it. And it doesn't make it any easier to write the check, of course, but at least it's there, to pay.
And you're avoiding penalties and interest. You're avoiding a lot of stuff. And again, basic tax hygiene, right? Okay. Qualified charitable deduction. Let's say you give Owen his 72. And this is really, really important. We are net since the Trump Tax Act. And when I say Trump or Biden or Obama, I am not being political. I'm indicating when it passed. So during the Trump administration, they really expanded the standard deduction. And so what that means is if you have mortgage interest, and that's typically the biggest one, if your house is paid off, a lot of my clients have a paid off house and don't have rentals, they're not itemizing their deductions. They're taking the standard deduction. So if Owen's got to take out a $3,600 required minimum distribution, on his $100,000 IRA. And I use this example because it's really not a big IRA. Owen can do a qualified charitable deduction, meaning the money goes from the IRA to his favorite charity. It does not go from the IRA to Owen and then Owen to the charity. If it goes from the IRA to Owen and then Owen to the charity, he's not getting an income tax deduction because he's not itemizing his deductions. So he's going to end up with another $1,000 a year in tax or whatever it is. This way, he's able to give the full $3,650 directly to the charity. But what you got to do is you have to reach out to the charity and say, hey, I'm going to do a qualified charitable deduction and I want to get you this money, but it's got to go from my IRA custodian to your institution, not through Owen. So that's a very powerful tool. And again, add a zero to that. We have a lot of clients who support charities. Many of my clients are extremely charitable, whether it's churches or synagogues or nature or animals or whatever it is. Many of my clients, very, very charitable. And this is a great way to keep that from coming into your taxable income. The other thing it does is it bumps up the portion you pay for your Medicare Part B. So it's something not to something really to pay attention to. So a lot of good reasons why you would want to do it directly to the charity. Okay, so let's say someone has a big capital gain. This is where the federal government and the state government differ. Let's say I have a big capital gain in a particular quarter. Chris, walk through this, why it's important to pay attention when you have a big, what I would call liquidity event or a big lump of money come in maybe. And the example we talked about is somebody sells their business and they have a note and the note's paid off. Maybe walk us through that and explain why you have to pay extra attention to it.
So what happens is if you're paying estimated taxes every quarter to both the Fed and the state, normally you can base the estimates you're paying in 22 based on what your tax was in 21. And if you do that, even if you owe more when you file your taxes in the spring of 23, you're not going to have any penalties because you paid in what's called a safe harbor. So you paid in what your liability was last year, and in some cases plus 10% if your AGI is over 150. The state of California came out about, I don't think 6-7 years ago and added some penalties that were just obviously income generators for them that said, if your AGI for the state is over $1 million, you can't rely on your income from your income tax liability from last year as your safe harbor. Meaning you've got to pay taxes as you go in your estimates to the state if you think your income is going to be $1 million or more in adjusted gross income. So therefore, or you get hit with a pretty good sized penalty. And it's something that if you don't plan for it, it hits you pretty hard. And so I was just telling Jim, I had somebody who was getting paid off on a note. Normally he's not over $1 million in AGI, but he's going to be because of this. And he got paid off in July. So July's in the third quarter of the year. So he's got to pay the state on the 15th of September. And we got to get him the number so he can do that. And we kind of know what it is, but we got to get him the voucher so he can pay by September 15th the total amount that he owes. Because if he waits and just pays his estimates like he has been, and then pays the difference come April, he's going to get dinged with that big penalty that Jim refers to down here. And that's just unnecessary.
And I will tell you, I know a lot of successful people, they don't pay as this, and this is very high level. They don't pay as much attention to federal, but if you're in California, you got to pay a lot of attention to state because it's a big number. And the other thing too, California does not have a separate capital gains tax. Okay, no. It's all income up to 13.3%. Stephanie has a question. Can you pay college tuition with appreciated stock? Stephanie, I would say no, the stock has to be sold. But one thing you might want to consider is depending on how much the tuition is, you could certainly gift stock to a child in college, and that child could sell that stock and pay taxes at their lower capital gains tax rate. Chris, back me up on this. I think that's where I'm going with that.
Yeah, they got to be 21 now, though, to do that. If they're under 21 still, they get hit with the kiddie tax. It's still ends up being parents' rate. So they get some things out there that kind of stop that.
So you might be better off taking student loans. And this is like an economic analysis.
Yeah.
Considering, speaking of student loans, You might be better off taking student loans and then paying them off with the appreciated stock that you give to your child after the child reaches 21. You see where I'm going with that? So again, this is like where you get together with your A team. And this is why, like, I know a little bit about this. You know a little bit about this, Chris. And together we know a lot more working together as a team. But what do you think about this tuition debt forgiveness?
Well, it's, I think there's some legitimacy to some of it, like when some of these schools haven't performed or didn't do what they say they were going to do. I think there's, and they got people to pay in a bunch of money. Then I think there's, some reasons to have some relief for some people. A lot of the other stuff, I don't know what the motivation is of it. I think.
Do you think it'll be taxable as income?
Well, I was thinking about that yesterday when I heard this going through, is that normally cancellation of debt income is taxable to the recipient. So let's say if you owed a credit card company $50,000 and you didn't pay them and they said, well, we're going to let you off with $3,000 and you off you go. That $47,000 is technically taxable. Now there's some ways to get out of it. If you're considered insolvent at the time or you file bankruptcy, you don't have to pay taxes on it. But when you talk about some of these people that are getting this $10,000, the question will be, is there going to be a separate provision in the code that says, yeah, that cancellation of debt is not taxable? Because for some people, it could end up being 30–40% of that still going to be taxed. So you get the 10 grand off, but then you got to pay 3 or 4 grand in taxes for getting it off.
Yeah. And so what's that doing is that's front loading the out of pocket, right? Because if you pay the 10 over time, so these people may find themselves in a tax hole.
But it'll be interesting when we get into the details to see if they've got that already handled in there. They may, this is so early because it was just yesterday, that it may say in there that this is not going to be taxable, but that's something the IRS and Congress, I would think, have to come up with. It can't be just coming from the president saying that well, we're going to have this. I guess he has the ability to cancel the 10,000, but I don't know if he has the ability just to say it's not taxable to the recipient.
All right. So accelerated federal depreciation came about in 2001, and this is really not a political hot potato, for lack of a better term. This is one that both parties agree on. Basically, what we're talking about is if you go out and you buy a car over 6,000 pounds, for example, right, you can deduct the cost of that car. If you buy a $100,000 truck, you're taking $100,000 off your federal return. State is still over 5 years in California. But what we're talking about here is also, you may have a company and you buy a $10 million piece of equipment that, has a life expectancy of 15 years. You can accelerate that depreciation in a single year. So that, if you want to kind of talk about this, that it's slated to be throttled back, and where are you seeing this going? Give me your thoughts on this, Chris.
Yeah, it's supposed to start being phased down starting next year. So it definitely is worth watching and planning for. Most of the people in our profession think that it'll get extended longer because, like you said, both parties like this deal. And it'll be interesting to see it. It may not even be extended right away. It might be something that gets put into something later in 23, and they'll retro it back to the first of the year, which means we won't know what they're going to do. Like if somebody calls our office and says, I want to buy a piece of equipment for $1 million, which happens regularly, and what's the deduction on it? And we're going to have to say in 23, well, right now it's going to be only 80%, right, the first year, until we know differently. Because I don't think they're going to make any changes to this between now and the first of 23.
So what about the other 20%? Is that taken the next year, or is it taken over?
No, you go over the life of the equipment. So the remaining 20% goes over the life of the piece of equipment.
And is that different based on the equipment? Is there like a
but most of it's 5-7 years. Okay. There's going to be some 10 and 15, but a lot of the stuff that the heavy duty equipment stuff you're buying usually is 5 or 7 years.
And when I was writing this, real estate is, I put this on here as a tax tip, because I have a lot of clients who are high income W-2 earners, and there's a real sense of frustration. They see the business owners get to take advantage of all these breaks. Now, bear in mind, when you're signing the front of the check as the employer, that's you got to get the money to sign the front of the check. When you're the employee, you sign the back of the check. And that's just a different thing. You know, you're giving up your labor as a W-2 employee. If you're the business owner, you're taking significantly more risk. I think real estate is a good long-term investment. I think in the short term, real estate has such a high transaction cost. What I mean by that is when you go to sell a piece of property, you got to go through escrow, you got to go through title, you're probably going to pay a realtor. You know, your transaction cost could be 6, 7, 8%. And that's a lot to pay considering, you know, if you put 20% down on a property and you have an 8% transaction cost, you're losing almost half your investment if you have to sell that property in the short term. So I think it's a good way to get rich over time, not overnight. Okay. Getting rich over time, I think, is a lot safer and create multi-generational wealth. And Chris, you and I see this. Clients make money in business. We have a lot of clients who have made money because they've held real estate for a very long time. And maybe talk about some of the, sort of at the bottom of the slide, maybe talk about some of the benefits you get holding real estate as a real estate investor. What, if I'm a W-2 person, maybe I should think about buying an apartment building or single family residence or whatever it is. Maybe walk me through some of the tax benefits.
Yeah, I mean, the tax benefits are, especially if you own your own business, it's great to buy your own space, especially if you got a warehouse need or something like that. You're manufacturing something, or, then buying your own space makes a lot of sense over time because you need a place to be anyway. And you're not going to be able to replicate that at home, especially, warehouse space or manufacturing space. So there's depreciation deductions and things like that you don't get as a renter. But as Jim discussed down below, real estate, when you're renting real estate out, not your own home or a second home, but when you're renting it out, the nice part about real estate is if you sell it at a loss, nobody wants to be buying anything to sell it at a loss. But if you do, you get basically an ordinary loss deduction for it, which is a good deal if that happens. But if you sell it at a profit, you get the capital gains treatment, much like selling stock. So you kind of win both ways with real estate, where stock, you don't really get that, because at a loss with selling stock, you can only take up to $3,000 of losses each year after you netted out your gains and losses. And also with real estate that you're renting out, you can also take advantage of 1031s, which are tax-free exchanges, to go into some other things. Like I've got a bunch of people lately, they're selling property because they're kind of retiring and they're scaling back, but they don't want to be out of real estate altogether. They still want to be doing it themselves. So they're getting more into managed real estate. So they're taking the equity and the gains from their properties that they've owned for a long time, and they've had to manage themselves, and they're moving all that over to managed real estate, and they don't have to pay any taxes on it. And they're now able to take advantage of all the equity that they developed over the years, that developed in this property, and move it into the managed real estate and live off of that. And that seems to be a pretty good setup for a lot of people.
And we covered that recently, the 1031 exchange, which is the Internal Revenue Code 1031 exchange, which is a verb and a noun, and it's all these, maybe an adjective in there somewhere. But it's a really important thing to understand if you have rental real estate and you're going to sell it, because it's a way of selling real estate and kicking the tax can down the road, if you will, right? Not paying that tax. Ken asks, going back to tip number 10, does buying an RV qualify for a tax deduction? Ken, this is business use, and I didn't clarify this. If you just buy a truck, it's got to be a work truck. If that RV is a work RV, maybe you're a window installer or something and you need an RV to pack stuff in securely. Yeah, I mean, if it's a business use asset, we're only talking about business assets, not personal assets. You're not going to get a deduction for personal assets. So, and coming in at number 12, I saw this, the former CEO of Pepsi-Cola speak, and she talked about mega trends. There's something going on that very few lawyers are talking about because it requires a multi-year view, but there are market forces at work right now. What I mean by that is lawyers with deep institutional knowledge are retiring or dying or whatever, right? Then just aging out right at the time where there's a surge in demand for people who need essentially multi-generational wealth planning. And then you overlay on this, you can leave $12 million plus per person tax-free. and that's indexed to inflation. Next year is probably going to be over 13 million each. You can leave that per person, but in 2026, it's going to get cut in half, and it might get cut a little bit more than in half, because the IRS, you know, there are laws, and then the IRS comes out with regulations and interpretations. And one interpretation is it's going to be 5 million from 2017 indexed to inflation instead of 5 million from 2011 indexed to inflation. So that's, you know, stay tuned for that one. But on a very high level, anything above that $6 million figure is going to be taxed at 45%. And that tax is due 9 months after death. If you have illiquid assets, not only do you have the pain of paying the tax, but you also have this pain of liquidating assets in a very short period of time. So it's very important to know, if you have assets, if you will have assets greater than $5 million at your death, you have to pay attention to this if you care. If you don't care and you say, you know what, if the government's going to take 45% on amounts over $5 million, I don't care, then you're probably not even watching this. But if you care, you need to pay attention to this, because there are a lot of things, and Chris, you've said this many times, that death taxes are frankly optional, right? They're optional. If you do planning in advance over time, not overnight, it's not a one and done, it's not a set it and forget it. But if you do planning over time, you really can leverage the laws that are out there to increase multi-generational wealth. And I will tell you, there's going to be a rush at the door, much bigger than in 2011. And if you kind of were prompted by your lawyer in 2011 to do a lot of planning, it's going to be like 10x or 100x of what that is. It's going to be a much, much bigger rush to the door, frankly, because the numbers are so much bigger. I mean, think about it. If you have a $24 million estate and you're married, you can do something to essentially zero out your tax bill. If you stick around and if you wait, it's $5, $6, $7, $8 million tax bill, whatever it is. It's a huge number. Actually, more than that. It would be almost a $10 million tax bill. So, all right. So there's your A team. Chris, you see where I put you?
I see that.
All right.
I like that.
So we got our offices in Northern and Southern California. And Chris, you've got offices in Northern and Southern California as well, correct?
We do. We have a couple offices in the Sacramento area, one up in Lake Tahoe, and one down in Glendale, and then one on Kauai as well.
One in Kauai. So if you're watching this from Hawaii, Chris might be your neighbor. So subscribe to our YouTube channel, super easy. Review us on Google. We really appreciate reviews. And if you have any questions, you can reach out to us. There's our phone number, and you can reach out to us. And your website is Mann CPAs, correct?
That's right.
MannCPAs.com.
Yeah.
We'll take some questions here before we wrap up. If you have a question, please put it in the materials. Charles, hey Chuck, how you doing? Any changes required as a result of the new act? Probably not with you. He's Chuck, you're a longtime client. Anita says, what does managed real estate mean? Can you explain this again? Yeah, so managed real estate is what you do is you sell your property and you go through a 1031 exchange into a managed portfolio of properties. And it used to be a tenancy in common or a TIC. Then those blew up in 2008, 2009. Now they're using a Delaware statutory trust, which is a business trust. And what you do is you sell your property and you essentially get shares in this Delaware statutory trust. So that means and I know I'm going, Anita, you're a realtor. So the problem with the tenancy in common is one tenant can raise their hand and say, I'm selling, and just drag all the other, 50 co-tenants with them to sell. The Delaware statutory trust solves that problem. And, I would say, like anything else, there is no one size fits all. What may be appropriate for one person is absolutely inappropriate for another person, but these are tools. And what we do is what Chris and I and the financial advisor that's involved, we look at this and we say, well, yeah, you could do this, you could do that. And this one looks like it might make the most sense for you, but really it's ultimately your call because it's your money, right? Alberto asks, do you do estate planning? I live in Texas. Yes, I just got back from Texas. I was in Dallas when they got more rain in a 24-hour period than they'd gotten in 90 years. I think they got 20 inches of rain in a day or something, whatever it is. So yes, we do, Alberto. We help people out in Texas. We're licensed in Texas. We do have an attorney license in Texas. Mary says, how many years has the property? Oh, great question. How many years does the property have to be a rental to use the 1031 exchange? Any thoughts on that, Chris?
That people have asked me that many times. I mean, it's, a lot of it's, what's your motivation with the whole thing? If I've seen people do it after a year, they turn it into a rental and then they sell it. I mean, there's some things you have to do. If, let's say, it was your primary first, and now it's a rental, there's some things you can do. But you can, as long as it's not a primary residence, and your primary motivation is not tax avoidance. I mean, nobody can stop you from going, hey, I want to turn this into a rental. Something happens, you get a job change, you get something happening, health issues, stuff like that going on. And you say, things have changed in my life, I got to do something different, so I'm going to sell this property. I think any of the 1031 facilitators would handle that for you, no problem, type of thing. And a year is, as long as it's not like somebody can come back and say that your primary reason to do this was tax avoidance. And I know 1031, that's what it is, but it wasn't like you made this plan to just turn this thing into a rental for a very short time, just so you could kind of exchange it. Your intention was just to turn it into a rental. And then at some point in time, you may exchange it, but because of some other things going on in your life, this was the time to do it. I think you're still okay. So if there's really not anything in the code, I would say you can't certainly do it for a month, but I would definitely say a year would be a good amount of time to at least show that your intention was to get this set up as a rental. And then, oh, by the way, I found this other opportunity and I want to, turn this into a, you sell this property and buy the other one in exchange.
Andrew asks, how you doing, Andrew? If I work from home, can my business purchase my primary residence? I would say, Chris, without giving, because Andrew is a client, without giving any legal advice, I would say probably no on a personal use asset.
Yeah, it's tough because you live there. They always, when you're living there and it's mixed use, the best you can really do with stuff like that, Andrew, is probably a business use of home deduction. The only problem is if you're an employee of a company, I've had this come up some with, people working from home more, you can't write off those things anymore because employees can't write off unreimbursed business expenses, and a home office is considered that. So really, it's a tough deal, especially if you're an employee. If you're running your own business and you own your own business type of thing, the home office is your best bet to go about taking a percentage of the home expenses against your business.
And Andrew, you should reach out to Chris and myself at the end of the year. You're going to need to do some tax planning. Jeff asked, do you do trusts in Florida? We currently do not have any attorneys licensed in Florida, but we do co-counsel with lawyers in Florida. So, if you're watching this and you're in another state and you want to use our firm, what we do is we identify, and we have several attorneys we've identified throughout the country. We can work together with that lawyer. It does not increase the overall fee that is charged because essentially the work is split between two firms. Anonymous asks, what happens to DST, Delaware Statutory Trust shares, when the owner dies? Are the inheritors required to stay in for the life of the investment, or is there any form of liquidity? Anonymous, the ones I've seen is you are stuck for the duration of the contracted period, which is whenever they decide to roll those over or end them. They're typically on a 7 to 10 year time horizon. So I would say the short answer is they're locked in. Now, can you sell it on the secondary market? Yes, but you're not going to get the numbers that, frankly, that are attractive that you would want. Ken asks, I have a rental and my daughter is the renter. Is there any benefit to doing a 1031 exchange versus just leaving it to her in our trust or will when we pass? Well, Ken, when you pass away, probably, under most set of circumstances, the property gets an adjusted cost basis. So Ken, if you're in California, the other thing you need to be concerned with is the reassessment, right? So that's another issue. So that's something we can certainly help you out with. But on a very high level, if you leave that 1031 property to her, if you're in California, first of all, when one spouse dies, you get an adjusted cost basis on everything if it's community property. But, a lot of my clients would leave the rental to the child, but it's important that you reflect that in your estate plan. If you want to leave that rental to your daughter, that should be indicated in your estate plan so that if there's any litigation following your death, they can't, if you've got a disgruntled sibling of your daughter, they can't, lie in the ointment. Are we licensed in North Carolina? No, but again, we have, we work with attorneys throughout the country. I'm part of an organization of about 5,000 lawyers across the country. And so we can help you wherever you're at. And that brings us to the end. Chris, thank you very much. It's been a pleasure. And thank you for watching, and be sure to check out our webpage because we have these about one a week. And look forward to seeing you, and we'll see you soon.
Thank you, Jim.
Thanks, Chris.
Take care, you guys.